Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report with Michael Hartzman and Dominick Tavella, with additional insight from industry veteran Jordan Kimmel. We'll break down the news, trends, and overall direction of the markets, telling you what may be coming next, investment opportunities, and what to avoid. Now, here are your hosts, Dominick Tavella and Michael Hartzman.
Good evening, everyone. I am Michael Hartzman. Today is Tuesday, March 30th, 2021. And as always, along with my partner, Dominick Tavella, both of us coming from Long Island this evening. How are you, Dom?
I'm doing great, Mike. How are you?
No complaints, thank God. Everything is all right. So I'm really excited about our guest this evening because you and I spend a lot of time every week talking about sectors. And last year was really interesting because throughout our long careers, we always tell people, well, you have to be diversified. You know, you can't get too top heavy in one sector or another. But last year, the script was really flipped. And last year, it wasn't as much as being invested in the stock market as it was where in the stock market were you invested and were you not invested. And tonight we have Richard Koerner, who's Senior Vice President of Sector and ETF Strategist at Fidelity Investments. And, his specialty is sector investing. So I know you and I spent a lot of time discussing it. And as I said, Dom, last year especially, and this year is shaping up similarly, it's as much as where you're invested as it is being in the stock market. It's perhaps no longer enough.
You could not be more correct, Mike. And I give you credit because you pointed this out on when we were looking at last year's portfolios, at last year's allocation. You know, we overweighted healthcare and we overweighted technology and basically sectors and the parts of the economy that would do well when the economy was closed down. And we did a pretty good job of avoiding those really, really bad areas, travel and leisure and real estate and things that really got hurt, right? So we always point out to the clients that, about half of the S&P was negative last year. And if you didn't own the 510 stocks, you probably were flat if you owned only the other 495. Well, this year, ironically, it's been the exact opposite, right? Which is shocking to clients. Like, oh, the market's doing great, but why is my portfolio down? And particularly large cap growth, large cap technology companies have not had a good year. And if you over concentrated your portfolio there, trying to play catch up from last year, you kind of got hurt so far.
Oh, absolutely. It's funny you should say that because last year the NASDAQ was up 69%. And that was after succumbing to a drop of almost 35%.
Yeah.
And this year it's kind of flat, and then there's been this rotation where last year the Dow was the laggard of the three major indicators, and this year it's the leading indicator so far.
If we look at the NASDAQ, it peaked somewhere around end of February. And off the top, the NASDAQ as an average is down about 9%. And again, as you said, the Dow and the S&P up nicely year to date. But if you sat on your hands and didn't try to rotate your portfolio, you missed it, right? You could be sitting with a portfolio that is negative. And boy, those speculative, we spent a lot of time talking about this, Mike, those speculative stocks, the SPACs, the really aggressive stocks have just gotten hammered.
Yeah, and I don't want to give the Redditors and the message board investors any more credit than they deserve, but it looks like a lot of the juice has been squeezed out of those oranges, and that type of the appetite for those types of stocks have really, really waned over the last month. I don't know if they'll come back, but they really are struggling.
Yeah, I think, and we call it risk off when we're discussing it, when we discuss it with clients. But I think the markets are in a mindset of risk off for now. And plus, we have President Biden getting ready to make some pretty significant announcements over the next day or two about what he plans: infrastructure, tax increases on individuals, tax increases on corporations. I think these are going to be market movers. Could be positive on the infrastructure side and negative on the taxation side. So we're really have our work cut out for us going forward.
Yeah, but we've been warning clients about that. We've been warning clients for a while now that someone is going to have to pay for all the stimulus and all these bailouts, whether it was, if Trump was reelected, maybe he would have kicked the can down the road a few more years, but someone's going to have to pay these bills. I mean, the money that this government spent is massive.
Massive, and I appreciate that Washington thinks they can just spend endlessly with no recourse, but that bill does have to get paid. For today, you and I have to decide how and where we need to allocate, and I think our next guest is going to give us a great opinion and an entree into where we should overweight and underweight our client portfolios.
So on that note, we will be right back with Richard Koerner from Fidelity.
Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report.
All right, I'm Michael Hartzman, back with Dominick Tavella, along with our guest, Richard Koerner from Fidelity Investments. And Rich, thanks for making the time this evening.
Thanks for having me. Pleasure to be here.
Joining us, Rich.
You're welcome. So, Rich, as we said on the open, and I know you were able to hear it, last year was really fascinating to us because the way we managed our models, we were not really bashful about having more cash than we normally do. So frequently in a model, we might have between 2.5% and 7.5% cash. And last year, we were not bashful about having, in some cases, 10, 15% cash. And then we would look at the results of the portfolio and we notice how well we were doing. And that's how, we really did this deeper dive and say, wow, there's overweighting into healthcare and technology. And more importantly, this underweighting into energy and to real estate was truly impactful, like nothing we've ever seen before. So last year, sector allocation really, really mattered. And it looks like it's shaping up that way again this year. So, just tell us what Fidelity did and your take on, how 2020 unfolded.
Yeah, no. So, listen, you guys nailed it. I mean, if you were in, those overweights, especially technology, for the, really for most of 2020, we started to see a shift, right around the election timeframe, which really coincides with the news of the vaccines being approved by the FDA. And since that time period, we've sort of seen this shift from technology, from healthcare, which we really believe at Fidelity are still the most innovative parts of the market. And even though Amazon is not in the technology sector, I think a lot of folks think about it. It's one of the FANG names. It's in the consumer discretionary space. But Amazon actually hasn't made a new high since July 4th. But I would tell you, at least here at my house, the number of packages haven't slowed down. We're not stopping to use Amazon. And I think for folks, as you rightly pointed out, like first and foremost, you need to have balance. Balance is so important inside your portfolios. But we've seen this movie before, especially when it relates to the technology sector. It has a big run up, and then the economy looks like it's starting to get its footing. You start to see rates pick up a little bit. Rates start to impact the longer duration equity assets, which technology is your longest duration sort of holding, and the technology stocks pause. And we've seen it before, but to us, this is just kind of a temporary move. Now, is it all of 2021? I don't think so, but I think the reflation trade and the sort of the reopening trade is probably getting a little bit longer in the tooth. And actually, I was looking at some one-year numbers, just year over year now. Energy is actually outpacing technology by 800 basis points. So that might, surprise a lot of folks. So I think we're getting a little bit longer into the reflation part of the trade, but to us, where innovation is going to happen, it's going to happen still long-term in technology and spots like healthcare.
So, Richard, just a disclosure to our clients and yourself, beginning in January, we started to lower our exposure in the tech space, particularly, not eliminate it. And I couldn't be more in agreement with you, but start to overweight dividend paying stocks and start to overweight, especially financials. A big chunk of that overweighting in the large cap growth space went to financial services. And those have done really well for us. So we're grateful for that. But, people are starting to think maybe we need to get rid of the whole large cap growth space and just overweight value. And I think there's too many good companies in that space to abandon it. And we need to keep a core holding there.
Yeah, I mean, without a doubt. I just think when you think about, whether it's Amazon, whether it's Apple, Microsoft, Netflix, you think about all the things that we probably push forward maybe a couple years of price growth into 10, 11 months due to the situation that we were in last year. And it needs a little bit of a pause, a little bit of a breather. I think the other thing too that you're starting to see with this market, specifically inside the tech space, is yes, Amazon is off its highs, Microsoft is off its highs, but not as bad as some of the more momentum-based technology names, some of the really, big high flyers. I know we're on Zoom, but that's certainly a name that's kind of come back here. We're still going to continue to use this technology, for the foreseeable future. But some of the more momentum-driven technology names have retreated a little bit further. And again, I think that's exactly the point you guys made at the top of today's podcast, and that's you want to be selective in your security selection.
Richard, are there any sectors now that still make you nervous that you would not put into the reopen economy yet?
Well, I would say, energy still has us concerned. It's certainly moved very far, very fast, and certainly has been driven by what everyone anticipating. We're looking forward to getting back on planes. We're looking forward to taking longer trips with our families and driving more. And you've seen certainly this week with the shipping incidences, but that could affect the price of oil. But I think one of the things that hasn't happened yet, but we've seen this happen in the past that just causes concern about energy are two big areas. One, the price of oil is really driven by supply and demand, and supply has been constrained. Okay, whether that's here in the U.S. with shale producers, they've done a very good job of having more fiscal discipline to shore up their balance sheets, to try to weather the storm. Saudi Arabia has had more restraint. Russia has had more restraint. Venezuela, Mexico. How long does that continue? Whether that whether you're talking about U.S. shale producers or the OPEC countries, a lot of those countries, their balance sheets, aren't very good. And, if oil prices move up and they feel like they can improve their balance sheets by increasing production, even by driving the price down slightly, we may see that, and we've seen that, happen in the past. I also certainly think there's there's an EV or green energy movement here inside the United States. There's certainly a lot of I think we'll get more information tomorrow, as you guys again talked about at the top, from this administration on an infrastructure bill. I think part of that will be tied to clean energy and certainly electric vehicles. And I think that's going to put long-term pressure on the energy space. And you can actually even see that with, the leading companies inside the energy space. They're talking about their carbon neutral programs, whether you look at, Exxon or Chevron. So I think the long-term outlook for energy is one that, this has certainly been the place to be over the last 6 months. I'm not sure it's the place to be when you look out, 5 to 6 years from now.
The other space we're hearing a lot of noise on is the real estate REITs in general. And I appreciate that the single family units, we just don't have enough of them in this country. And there's been just madness in price appreciation. But when you're looking at the strip malls and you're looking at the office buildings, considering what we're going through right now, kind of scares me. So we've still avoided it. Maybe we've missed out, but I'd love your opinion on the whole REIT space and real estate in general.
Yeah, no, I think a lot of times when clients ask us about real estate, what they're thinking about is, in my neighborhood, prices are moving up, or I was at Lowe's, buying mulch and getting ready for spring, and it's really busy, and there's a lot of home builders, so they're thinking a lot about residential real estate, which is certainly done very well, and certainly in this stay-at-home environment, it's certainly helped the home builders and the retailers like a Lowe's and a Home Depot. But actually, your home builders and your Lowe's and Home Depot are in the consumer discretionary space, which again, when you're in that large cap area, you tend to find most of that inside your large cap growth strategy. So I think that's an area that's still going to continue to do well. And then in the real estate area that you were talking about, when you think about names like Simon Property or Regency, that own malls or retail areas, I think you're exactly right. I think the outlook is still cloudy for a lot of those areas. And again, you need to be very selective with the REIT marketplace because not all of them are going to recover and rebound, at the same pace.
So, Rich, just getting back to infrastructure a second, Dominick and I are both old enough to remember the 2008 financial crisis. And we heard the expression shovel-ready projects over and over and over again. And really, that turned out to be a hoax, right? There was no shovel-ready projects. And then in the first 2 years of the Trump administration, it was Infrastructure Week literally once a month. Right. And there was no appetite for any bipartisanship. There was no appetite to give any side credit. So what makes it different this time? Why does tomorrow matter?
Well, I mean, I think you're exactly right in that there's probably more bark than bite, and we'll probably see a pretty big proposal number from the president tomorrow. But when that number if that number gets through Congress, it'll probably be significantly reduced, and then it'll be spread out over 10 years. And over that 10 years, there'll be a commitment, so it could possibly be, I'm just making these numbers up, it could possibly be 500 million in year one, but the amount of dollars that are actually spent are usually on average around half of that amount, in a given year. So I think you guys are exactly right. I think there's a lot of excitement about it. I think the market's probably already priced most of that in. For us, one of the best ways to get some exposure, but not just limiting yourself to pure infrastructure, is the sector of industrials. Because you get machinery, you get trucking, you get some of the beneficiaries of a potential, infrastructure, but you also get aerospace and defense, companies. You get a very well diversified sector that can certainly participate in an infrastructure reopening or infrastructure bill, along with the overall economy reopening.
So I guess that's the perfect lead in, and I was going to save it towards the end, but where are still the best opportunities if you look at the balance of this year? And we like to look at things more in a 3 to 5 year time frame, but where are the best opportunities still going forward?
Well, I've been telling folks, listen, I don't sound very smart, and I'm not sure how long I'm not going to look very smart with this, but our favorite idea, our favorite sector to talk to folks about, especially answering your question 3 to 5 years, is still healthcare. Healthcare, when you look at the valuations inside the healthcare sector, going back over the last 45 years. Healthcare stocks have only been this cheap one other time, and that was in May of 2009. And if you actually go back, to October of 2008 and look at the performance inside the healthcare space from that point until the end of this year, you're up over 430%. That's significantly outpacing the S&P 500. That's up just over 310% during that time period. And so, to us, you've got a really strong valuation story, and it resonates across the entire sector, whether you think about managed care companies, whether you think about pharmaceutical companies, whether you think about biotech companies, even a space like medical technology, which usually trades at a little bit higher premium, is trading below its historical average and the overall market. So the sector looks very cheap from a valuation standpoint, and the earnings are really strong. So it's not a value trap. It's not just cheap and not going to grow, but the earnings growth trails only technology in terms of its contribution to the overall market. And so to us, the valuation story coupled with the earnings story, coupled with the innovation is certainly we've all seen with vaccines and the mRNA, but certainly just overall contribution to society, and the fact that we're all getting older. We've got an aging demographic here in the U.S. We've got an aging population across most of the globe. We've got increased utilization, and I'll add one more thing that has us excited about healthcare that I don't think the market's talking a lot about, but of the most recent stimulus coming out of this administration and Congress, $1.9 trillion, 12% of that is geared towards the government increasing healthcare spending. All right. And so when the government tends to increase its healthcare spending, healthcare stocks tend to move in lockstep. So you see that increase in government spending, you tend to see a move along with the healthcare stocks. We've not seen it yet. We've seen a little bit of a pickup here recently as the market's kind of rotated towards some more defensive names. But I think healthcare stocks are, if you're looking at that 3 to 5 year time horizon, this is an area that looks very attractive, on multiple metrics.
Rich, doing a little deeper dive and looking into some of the subsectors that we look at, are there any sectors that either you feel the hype is well founded, or any sectors where you feel that the hype is going to disappoint? I guess what I'm looking at is either electronic vehicles or clean energy or cloud computing or crypto. Are there any sectors out there that you really think, God, people are really in for a disappointment?
Well, how about this? I'll answer that one by saying, how about the area where you're seeing a lot of interest in the news, you're seeing a lot of articles, and we think you're right. Like the story is right, and that's the area of semiconductors, because it ties back into electric vehicles. It ties back into whether it's our cell phone, chips, the cloud, 5G. We actually all across the industry, there's a semiconductor shortage. Most of the newspaper articles that your clients are probably reading about are talking about the auto manufacturers and a slowdown between 300,000 and 400,000 less cars being produced here in the first quarter. You're starting to see more articles about new plants being constructed here in the United States from Intel, also from Taiwan Semiconductor. But the part of the story that isn't always publicized is the fact that those plants aren't going to come online until 2024. So I think this supply, the demand imbalance is going to be here with us for a little while. So I think the setup is very attractive, for semiconductors. And then I'll reiterate one point that we always make when we talk about industry level. So semiconductors are within the technology sector, just like biotech is within healthcare. And certainly anytime you come down from that sector level to the industry level, you increase the opportunity, for return, but you also increase, the volatility and risk because you're narrowing your focus. It's just, as you guys talked about, when you move from, large growth into, just owning one sector or, adding, to one sector. I think it's important for folks to understand that I think it's great exposure, but it certainly can increase the volatility. But it does make a nice complement as to owning, do I own Intel or do I own Taiwan Semiconductor? Do I own AMD? Some of the chip names we're we're down today, when you get that diversified portfolio, it's certainly a great way to get exposure to an area that we think is going to help drive a lot of the growth in some of the areas that you talked about.
And Rich, if I can piggyback on that same question, but in the healthcare sector, you guys have a lot of sector funds, a terrific lineup. Do you narrow it down and maybe do biotech? Do you narrow it down in that healthcare space and try to get a little bit more specialty in your portfolio?
Yeah, well, our healthcare fund is really just the all-in-one solution that gets you roughly 25% in biotech, another 25% in managed care, 20% in medical technology, and so you get a really diversified approach to your leading sectors inside. Your leading industries inside the healthcare space. So to us, that's the all-in-one solution. But there's a strong case to be made for owning biotech by itself, and the fact that biotech. I mean, you guys brought up 2008. In 2008, there was no place to hide from a sector perspective. And while it's not you're excited about losing 12%, biotech only lost 12% in 2008 because it's not as correlated to the overall economic market. I mean, it has a lower degree of sensitivity than you'll find in other spots, and it's really driven on how are these companies doing, what drugs are they bringing to market, and so there's I think a strong case for owning biotech by itself because of that diversification. But same point with biotech as it made in semiconductors. You just need to be mindful of the additional risk at that industry level. But certainly in our viewpoint, better to own the fund than to look down and go, well, maybe I ought to think about 100 shares of this particular biotech company.
Richard, thank you. As always, this 20 minutes went flying by. We could have had you for 2 more segments, but unfortunately we're out of time this evening, and thank you for joining us. And we will be right back,
and I'd love to continue the conversation. Thank you.
And we will be right back with Jordan Kimmel and his guest.
Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report with Michael Hartzman and Dominick Tavella. We'll break down the news, trends, and overall direction of the markets. Now, back to the Lebenthal Report.
And welcome back, everybody, to the Lebenthal Report. I'm Jordan Kimmel, the Chief Equity Strategist and Portfolio Manager. And it's an absolute pleasure to bring on what's become a friend of mine. Who's become a friend is Barry Sloane, the Chairman, the President, and the CEO of Newtek Business Services, Inc. And Barry, thanks so much for joining us tonight.
Jordan, thanks for having me. Really appreciate the opportunity to be on the show.
Well, it's going to be fun. We have some time to dig a little bit deep. I really want to actually set a background and a backdrop, Barry, to our relationship. We met over 10 years ago. And while Barry is represents a public company, we're not making any recommendations here. I will tell you that Newtek is in our portfolio. We do fundamental work. And about 10 years ago, almost, I went to a small cap conference, and Barry was, yes, a very small cap company then. And I did my magnet stock selection process. And out of the 80 companies there, I made a point to meet Barry because his company was the highest ranked. I met him in his office. We became shareholders and collected a lot of dividends and a lot of appreciation since then. So it's a long time. And Barry, congratulations on what really was something that you started many years ago as a tiny company.
Yeah, I appreciate that, Jordan. We've been in existence now for 23 years, 20 as a public company. I'd like to say we're an overnight success. It just took 20 years. We're quite fast.
It took a whole lot of work. So what I want to do is I want to dig into the economy itself. But before we do, your company is a business development corporation. It's kind of a new term. And so why don't you kind of explain what a business development corporation is, and then how maybe Newtek separates itself a little bit, and we'll get into the economy after that.
Sure. A business development corporation is a term of art created by the Security Exchange Commission to create a vehicle in which entities labeled as BDCs or business development corps can provide financing and mentoring services to independent business owners. That's the technical definition. A BDC, from a financial perspective, is technically a mutual fund. We are a very odd BDC in that we have operating businesses under the publicly traded BDC umbrella. Most BDCs are basically investing or purchasing debt instruments, putting leverage on it, and clipping a coupon. BDCs, similar to REITs, must pay out between 90 to 100% of all income. So therefore, most of their income is paid out in the form of a dividend. Most BDCs are simply income instruments paying dividends. We've had tremendous capital appreciation over the years because in addition to paying a healthy dividend, the share price has gone up because we keep increasing the dividends. So our total return, according to Bloomberg, over 10 years, about 400%. So it's an odd instrument, but it really fits what we do very well from a corporate standpoint.
Right. And so again, in full disclosure, Barry, I run 4 models at the company here at Lebenthal. One of them focuses on dividends, but we're not looking for the highest paying dividend. We're looking for companies that can increase their dividend over time, increase their business operations over time, and therefore we get an increasing income. And so I do a lot of analysis. I do a lot of spreadsheets. And, frankly, not everyone knows the name Newtek yet, but NEWT, again, no recommendation. But I not only do the spreadsheets, I kick the tires. I came to your office and I see the way you operate. And so let me just share this. Many years ago, I'll throw out a funny name. George Bailey used to give out loans in the neighborhood back in the days of It's a Wonderful Life. And then it became Citibank, maybe I'll just use that name, Bank of America, what have you, that became the loan center. It's a different environment now. It's a different world right now. And with regulation and certainly with what happened last year, please share, what the changes in the overall economy and maybe your insights. I know you used to go on every single week and update through the SBA insights you have on how the true economy is doing. So let's just jump off from there.
Well, look, I think that one of the things that the pandemic has done in COVID is it's really magnified the importance of independent business owners and what other people define as small and medium-sized business in the United States. According to the Small Business Administration, small and medium-sized businesses, it's 9 out of 10 businesses as defined. It's 50% of non-farm GDP. It's 40 to 50% of people are employed by small business. So right. I think that the pandemic has magnified really the importance of this economic engine for the U.S. economy. And our company was designed over 20 years ago to provide the financial solutions and business solutions that Fortune 1000 companies get, down to what the SBA defines as 30 million businesses in the United States that fit this definition.
Amazing. And again, we still hear, Barry, somehow the non-farm payrolls. Not a lot of people are working on farms anymore. And frankly, a lot of the companies, like you say, have under a certain amount of employees and don't even really get counted in a lot of surveys. So I'm going to make just a comment here. I see a very steep yield curve. Although yields are very low, I see a steeper yield curve, which means to me, good business tidings ahead. And maybe you could talk about maybe the loan demand you've seen, and through the SBA, the incredible amount of loans you provided, while there's a lot of need in this country.
Yeah, Jordan, I mean, the one thing, being in the markets for as long as we have, always expect the unexpected. Typically, contrarians win out. So if you think back a year ago, things were looking really, really bleak across the board in every aspect of life. Today, it's total opposite. And part of that is the monetary and fiscal stimulus that's been pumped into the U.S. economy. It is unprecedented. And we're on a good growth trajectory. New business formations are up. There is tremendous liquidity awash in the system. The federal government is providing tremendous stimulus to individuals through the checks that individuals are receiving. There's so much liquidity and monetary and fiscal stimulus, this economy almost can't miss. Yes, there's still issues relating to the pandemic. The shutdowns have weakened a lot of businesses that were on the bubble going into the pandemic. So that probably is going to accelerate some businesses going out of business. Many of us will walk down Main Street, or they'll look at various retail establishments that are closed. I'm telling you, 6 months or 9 months from now, it's terrible that a lot of business owners got wiped out. Those spaces are going to get rented. There's new money coming in. The economy is in a very strong spot. I think your point about the steep yield curve, I think you've got to expect inflationary expectations. You almost look at every aspect of business. There's going to be, in my opinion, shortages of labor, materials. You look at oil, rates are going to go back up. The Fed can keep things down for a period of time, but unless they start buying bonds, long-term rates are going to go higher. We've got a good road ahead of us economically, I think.
Right. Well, Barry, they'll keep buying bonds. I agree that there's a great road ahead of us. They're going to keep buying bonds. They're going to keep supporting. And again, I think that, let me just mention here, I'm not a proponent of the stock market. You know, if you know me and you know me well enough, most companies don't meet the street, you know, the criteria that I actually create. Same thing with banks and loans. I mean, you don't give a loan to everybody. Fact is, maybe there was a period of time where everyone can get a loan and fake, you know, income, whatever. I think it's actually a good thing that there are regulations, not regulations so much, but each company can make the own loans they want and live by them or not live by them.
Well, look, at the end of the day, capital allocation is extremely important, whether you're lending money or putting, you know, making an equity investment. You got to get a return. So, you know, capital allocation is extremely important. We don't want to be in an economy or a situation where the government is spending money unwisely, not getting a return, or that private business is spending money unwisely and not getting a return. Fortunately, there's tremendous opportunities due to technological changes that we're seeing in almost every aspect of industry. And I think that's going to fuel economic growth for many years to come.
Well, I agree. You know what? Before I run out of time, what I want to do is I want to bring on Dom and Mike that love to look at kind of the big picture, the macro picture. If the engineers can bring on Dom and Mike right now, I'd love them to kind of jump in. I think they look at, you know, there's always questions about where rates are, what's going on with business. So Dom and Mike, jump in here, please. Barry's got his finger on the pulse of the economy like very few people do. Take it away.
Dom, you go first.
Barry, you already brought up something that I don't think really gets a lot of press. We're always talking about the unemployment number, and obviously very concerned about that. The number of businesses that just won't ever come back because of the coronavirus. But how many new business formations have we had in the last 12 months? I think the number is astronomical. You want to talk a little bit about that?
New business formations are going off the chart. There's tremendous liquidity in venture funds, private equity funds, because they need to get those returns. You know, you hear of locations, for example, of restaurateurs moving locations to more sunshine states. People are changing locations. There's reasons for movement. People are going from brick and mortar to e-commerce. So we're very excited about the opportunities. You've got to invest wisely. Today wouldn't be the best day to invest in a dry cleaner, for example, or for that matter, in an office building or in a retail strip mall. So you've got to be, to Jordan's point, you've got to be very selective where you're putting the money. but there's plenty of capital. And with this transformation using technology, there's a lot of great ideas out there to make money.
Barry, this is Michael. Thank you for joining us this evening. It's easy to criticize the government, and I think most people's knee-jerk reaction is to criticize the government. But would you say that the PPP program that the government rolled out a year ago, and then I think they did it two more times since then, to me, as a small business owner and having colleagues and clients who are small business owners, it would strike me that the PPP was a success. Do you have an opinion on that?
I do. So, and I appreciate you making the comment, because a lot of times people ask me a question and I'll go 0 or no, and it's never zero. The answer is never 0 or no.
Mm-hmm.
So if you look at this distribution and say, gee, was it, the bottom line is wildly successful. Was there some element of fraud and misallocation of capital? Yes. However, the speed of which the money was put out, the infrastructure that the federal government used, which is using 4,000 SBA lenders in all geographies with minorities, women-owned businesses, to put money into the hands of independent business owners that can keep the payroll, keep the lights on, keep the business going. It was a very wise investment, because when you lose that infrastructure of business and it gets destroyed, it takes a lot to bring it back to life. So that was a very smart investment that the government made with respect to the PPP program. And as you're aware, it's still going on. It's been extended for another 2 months. We've been a major participant. We did 10,500 PPP loans in 2020. We haven't announced it, but we've got a big participation in this calendar year as well. A lot of business that we were able to fund.
If I can jump on that same theme. So I came across a company like yours many years ago. I was almost startled to find out that you guys exist out there and what you can provide to the small business owner. So maybe you can just talk about how somebody comes to somebody like you and what kind of arrangements or deals they can make to help them grow.
Sure. I think we aggregate the majority of our customers using channel partners that don't want to make or can't make the small business loans or payment solutions or tax solutions or payroll, health and benefits or insurance agencies. We specialize in these 5 silos and provide the solution. So you clearly can come to us through our website, newtekone.com, newtekone.com. That's how you can find us. Or there are channel partners that drive customers to us. The most important thing about Newtek, no branches, no bankers, no BDOs, no brokers, so that there's no intermediary salesperson. You're dealing directly with a solution specialist in a remote location that's able to provide a solution. So if you're looking to get taken out for breakfast, lunch, dinner, or golf, we're not the place, okay? We just give you the best solution at the best price, no frills, and we're able to do that remotely. So the pandemic environment actually fit our business model very, very well, because we deal with small and medium-sized businesses. They want us to be available when they have the time during their week or evening or weekend. That's what we do. So we're 24/7. It's a solutions-oriented company.
Barry, let me jump in here to close it out, because we are going to bump up on time. And I'll remind everybody, this is not a recommendation itself. You do your own homework. I did my homework. I kicked the tires. But we're going to keep watching. We're going to keep, numbers oriented, Barry. But you are, to me, an American hero. Guy who started the company in a spare bedroom, now providing loans for tens of thousands of people in crisis. And just keep up the good work. And we hope you're a portfolio company for the next 10 years, frankly.
Thanks, Jordan. You can see I'm still in the bedroom, but I appreciate the opportunity to chat with you guys today.
And there's no substitute for hard work. I know how you work. So thanks a ton for taking the time. We'll be right back with more Lebenthal Report right after this.
Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report with Michael Hartzman and Dominick Tavella. We'll break down the news, trends, and overall direction of the markets. Now, back to the Lebenthal Report.
All right, so we're back. And Dom, we had two good guests tonight. And I guess the takeaway, is twofold. One, from Fidelity, it really matters as much as where you're invested and where you're not invested. And for me, the takeaway from Barry was, we talk about these huge, gigantic multinational companies all the time. That's what the stock market's focused on. And here's Barry, creating this company that is really dedicated to truly the engine of the U.S. economy, that proudly you and I are part of, being small business owners, that gets frequently overlooked.
It does, Mike, and yet I throw out a stat all the time that small businesses are responsible for somewhere between 60 and 70% of all the jobs created in this country. They are integral to the fabric and the growth, and we can talk about these large institutional corporations that are multinationals and sell all over the world, but the core of this country is that small business owner, especially that individual that starts a new company. And we touched on it just a little bit about the number of new companies, new businesses started, people literally starting businesses out of their bedrooms because they didn't have a choice, Mike, right?
I know. And to me, I've always said that the person who has the guts to sign a lease for a storefront is an American hero, because they literally put their fortune, their lives on the line. They unlock the door and they literally hope people show up.
And Mike, I can poke fun of myself on this one, but you started a business from scratch, your business, and I started mine out of a spare bedroom in my house back in 1982. And I always joke that I was just too dumb to know that you weren't supposed to. But if somebody doesn't have the courage to do that and start, and then eventually maybe go to somebody like Barry for capital and grow and hire more people and grow and hire more people, then the engine of this entire country doesn't flow. It doesn't grow. So it's so important to our future.
Yeah, it really is. And then switching gears and getting back to Fidelity, I was really happy to hear that Fidelity is still, pretty excited about the tech sector and the healthcare sector. It's not going to be a rocket like it was last year, but there's still plenty of upside in those sectors, and that's also widening as well, which is good to hear.
Yeah, we touched on that we've lowered our exposure in the large cap growth space, but we did not in the healthcare space. And he touched on some really key points here, and that is that as a population, we're all getting older. We're all going to live longer, God willing. We're all going to need more medical care for a longer period of time. And certainly the government is in a mood and seems like it's going to be expanding under the Biden administration to provide even more health care. So we've had a little bump in the road here in the healthcare sector. It's about flat this year. We basically hasn't done much of anything, but I think longer term, maybe the balance this year, but certainly over the next 3 to 5, I don't see that's a sector us moving out anytime soon.
Yeah, I would agree with you. And then finally, Dom, I'm going to do something. I didn't tell you I was going to do it, but it's kind of been a rough week for the two of us, especially for you. If we lost a friend who worked for you, who would love these conversations, who would love to be a part of these conversations, and he fought a battle for a long time, and he unfortunately lost that battle last week. So I like to dedicate this show to Abe Sager, who is a dear friend to you and a mentor to you. And he would love watching these things and being part of what we're doing.
Well, certainly it's a tough one for us to swallow, and many in this country have lost loved ones, and whether it's family or friends or acquaintances, business associates, so we're not unique in that. But this one hit home for all of us, Mike, and it's a loss of a dear friend and an employee that's been with us for a very long time. So our condolences to the entire Sager family. Yeah. And his clients are all, as we are, all brokenhearted. But this is unfortunate times that we're in, and this is just indicative of a lot of pain that a lot of people in this country are going through right now.
Yeah, absolutely. Absolutely. And, may he rest in peace. And I'm sure he's looking down, and he would jokingly call us Titan and Titan One. So I'm sure he's looking down and proud of what we're doing with this show. So on that note, I will see you next week, and everybody stay safe.
Have a good evening.
Thanks for tuning in to the Lebenthal Report. Dominick, Michael, and Jordan will be back for our next program, airing next Tuesday at 2 p.m. Pacific Time and 5 p.m. Eastern Time on the Voice America Business Channel. Until then, have a great week.